Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 26th of September. I'm Daniel Lam, your host for the podcast. One of the major changes to our recommendations in our most recent global market outlook was our upgrade of US equities to overweight. So the arguments against US equities are quite well known, mainly the expensive valuation and that the rally has been lacking in breadth. On the other hand, US companies have beaten expectations in the latest earnings season, and their earnings growth is expected to outperform other regions, with AI and technology-related industries likely to fuel earnings expansion. Besides the strong micro performance of the companies, the macro front is also looking reasonable. In the latest FOMC policy meeting, the Fed revised up the GDP growth numbers and revised down the unemployment rate. The Fed is basically expressing the view that the US economy can remain steady versus the rest of the world on elevated rates. The rise in nominal and real interest rates has led to a strong US dollar, which appears to be sapping liquidity away from the rest of the world into US assets. Now, our global research colleagues pointed out that since January 2011, the S&P 500 has outperformed MSCI Emerging Market Index by 143%, excluding dividends. And that's largely mapping a rising trend in the US dollar. The FOMC's higher for longer stance presents a significant challenge for EM central banks in particular. If the FOMC is not cutting rates, EM central banks may be reluctant to cut their own policy rates for fear that the widening rate differentials may lead to capital outflows, and that may exacerbate the weakness in local currencies. So they either keep rates stable and risk slower growth, or they cut rates to support growth and risk imported inflation. The final option is to use fiscal policy lever to support growth. But for some EM economies, that may raise renewed concerns about debt versus GDP levels and fiscal sustainability. So that, together with lackluster economic performance in China, weigh upon EM and Asian assets in general, and thus we also downgraded Asian ex-Japan equities to neutral. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.